All right, good afternoon, everyone. Please let's confirm if you can hear my voice.
Good afternoon, sir. I hear your voice.
All right, welcome to financial management class. My name is Sadiq Okikiola Ahmed, and I will be your tutor for this class. And as you all know that this is new syllabus in the skill levels of ICAN professional examination, and there have been different reactions since the new syllabus come out, especially for this particular course, that it has not been previously examined by the institutes. And currently, we don't even have an official materials for you as a guidance. But here at JPS Professional Tutors, we have done our best to come up with a plan and a strategies to make sure that you pass this exam gracefully. So that is our plan, and I believe all of us have access to the summary notes that I sent to the group. Do we have it?
Yes, we have it, sir.
Yes, we have it, sir.
All right, that's fine. Because
We have it.
this financial management, it's I would say that currently in this case, it's going to be one of the easiest course for you to pass. The reason being that first, it is new course. So I know this diet, the institute is going to at least come out with something not that complicated, that they know that if you read in a normal way that you're supposed to do, you should be able to pass it. And secondly, the course is type of the course that it only need your understanding. So your understanding of the course is enough. And it is also type of the course that I believe for some of us that come with come with a social science background, whether business management, accounting, banking. So it is type of the course that we should have familiar with during our university or polytechnic days. So it is not something that's going to be difficult at all as far as we do what we need to do. So first, we start with the overview of the course. Then, what is going to be our plan? How are we going to structure our class in managing this course? So the first thing that we say is the linking, the relationship between the amongst the ICAN courses from the foundation skills to professional levels. This course is well linked up with business environment. That is also new course in the foundation. So for the people that in the foundation, they will see a glance of financial management in the business environment. And also, this financial management is well linked to the strategic financial management in the professional levels. Because one of the reasons that those that have been taking uh, financial, what is the name? Strategic financial management in the professional level, sometimes we used to see the course as the most difficult course in that level. And the fact is, there is no any precedency to hit in skills. So, like the course that the financial management has been replaced, corporate social management, CSME. So it just talk about, let's say, like 10% of it has a content of strategic financial management. So, but for this financial management now, it's like a build up that if you study it well now, you are doing two things at the same time. Because if you can really grab it, it's going to be very easy for you to pass your strategic financial management. And the content of this course, uh, the one that now that they have relegated this CSMA, they bring some part of it and some part of performance management and also some basic part from strategic financial management in the professional level. That is what make up of this course. And in time for the examination purpose, the arrangement that is not changed from what the way it has been done before. So when you are writing your exam in skill level, you are expecting to have 7 questions for your exam. And the number one questions always used to be compulsory questions, which is going to be 30 marks. You don't have option, you have to answer it. And question 2 and question 3 used to carry 20 mark. So there you are going to have 4 questions from question 2. No, you are going to have 3 questions from question 2, question 3, and question 4. It's 20 mark. And you have option to answer 2 out of that 3. So 20 mark, making your mark 70 mark. And for the question 5, 6, and 7, it used to carry 15 marks each. And you are also have options to answer 2 out of that 3. So that is 15 mark, make up of 20 marks. Made up of 30 marks. So you have your 100 mark. So, and this question is combination of theory and calculation. So the same thing like your PSAF, public sector accounting, that you have calculations, you also have theory. So based on the content of this course, I will advise that you should be expecting 60% of calculations and 40% of theory. So that tell you that both calculations and theory are very important in this course, because theory is always easy to pass. Calculation too is also easy to pass. It's just based on individual differences. Some they will say they prefer calculation to theory, and some will claim that they prefer theory to calculations. But in my own take, I also prefer calculation to theories, because I know it's something that step by step, anything that I get, any step that I got right, I'm going to get mark for it. But still, there are part of the theory that I always prefer to do calculation. Those theory are the type that I can use my idea. I just need to understand it and put it down in my own words. So such theory are very easy. Once you understand, you don't need to go and check. You don't need to even say, I want to revise. I want to check what they wrote here, how they define this. Your understanding is enough. And fortunately, this theory in this course is type of the theory that you just need to understand. So moving on, I'm quickly going to give you the contents of financial management. So this financial management has 6 parts. So, and the first part, which is part A, is dealing with financial management principles. So, which is just the basic principle of financial management. What is financial management? What is the function of financial manager? Economy, environment of business, and the market. And that is what we will be talking about today, because this we set a foundation for the other theory and our calculation. Today's class is very important for us to lay a good foundation going forward to the other parts of the content. And for the part B, we have working capital management. So working capital management, so I believe it is something that all of us, I believe that we should familiar with it already. What is our working capital? Current assets minus current liability, cash management, cash life cycle management, from the place that you order from your supplier to the end where you receive the payment from your customer. So are simple things that we have been done since. And part C, we are going to be talking about investment appraisal. And one thing that have been omitted, part A, that financial management principle, the weight is 10%. So it is also important for us to understand how ICAN used to set their exam, the logic they used to use. Because one thing is, I believe all of us that we are here, it is not that maybe we cannot read. Even on our own, we cannot do it. We can do it. We can read and understand. So, but as far as exam is concerned, like, let me say 50% of your skills, your brilliances, and also 50% of your exam strategies. So you need to have strategies. You need to have the skills, how to pass exam. How to pass exam is another skills that we need to acquire. So this financial management principle carry 10% of the whole content. And the part P, which is working capital management, also carry 15%. So part C is investment appraisals. So that is one of the core area of this financial management, investment appraisal. It is also something that we have used to, like our net present value, accounting rate of return, payback period. Those are these that you have projects, whether they are mutually inclusive or they are mutually exclusive, whether to accept your project or reject it. So that is our investment appraisals. And also, and that carry 25%. That investment appraiser carry 25 percentage. And part D, we have business finance, how you are going to raise capital. Because when you have projects, you need money to finance it. So the different sources of raising finance and the risk associated to the different sources is going to be explored in this part C, and it also carry 20%. And we have also part E, business valuation, which is carry 15%. So different this business valuation, when you want to invest in a company, you want to buy a share, or you even want to acquire, or in the merger, uh, in the merger situation, when you want to merge with another company. So you need to follow each company to know what it's worth. And this business finance and business valuation is largely discussed. It's the main focus area when you go to strategic financial management in the professional level. So you are going to see the main thing. I believe what we are going to be doing here, it's going to be at the basic level. And the last one, we have risk management. So risk management, we have different type of risk: market risk, liquidity risk, currency risk. But here, as far as financial management is concerned, the risk that they used to focus at most is the currency risk. How you are going to manage your foreign exchange risk for the international business. So here, this part C, investment appraiser, and part D, business finance. So it's one of the area. That is why I'm talking and also giving you exam strategies. So these two parts, part C and part D, you have to study it thoroughly, because it's either two of this that you are going to be expecting your compulsory question, which is number one. And let me tell you, this it is a top secret that I will use this opportunity to tell you, and I'm telling you this for free. ICAN has many policies. That is why sometimes most of you, if you have been written ICAN before, or you know those that they have been written and failed, someone will tell you that he or she answered the question based on what he has done. He believes that he's supposed to pass this course without any doubt, and he's going to still fail that course. So many people don't know why. So the reason being is, I have told you the structure that question 1 is compulsory question, 30 mark. Question 2 to 3, 20 mark. You are going to answer 2 out of it. Question 4 to 5 to 7 is 15 mark. You are going to answer 2 out of them. So there are some courses which this is included: financial management, strategic financial management, audit and assurance, and financial reporting, both in skill, financial reporting in skill, financial reporting, now strategic business reporting in professional level. So they have some certain courses that they need something that they are expecting you to achieve. And where I'm driving at is that the main theme of this course is investment appraiser and business finance. That is the main purpose. That is the main. All other things that surrounding it, like currency management, working capital, is just an addition to make up the content. So that is the main theme. So any student that writes that paper and that question come up from that question one, that compulsory question. Maybe the investment appraiser question come or business finance question come in that, and you cannot able to answer it. At least you cannot get 15 over 30. Maybe you are getting 5. Forget, maybe question 2, you get it correctly, you get 2020. Question 3, that even without question 1, because question 1 is only 30 marks, you still have 70 marks, and the pass mark is 50 marks. Without even answer that number 1, you can pass your course. But with that number 1, they believe that if you cannot, that you have not get it, if you cannot answer the core subject of that, the core topic of that course, that you are not supposed to leave the course now. So, and they believe they are justified their policy. So that is why if you are writing financial reporting, strategic financial reporting, you have your main question when they ask you to prepare financial reporting or consolidated statement of financial position, a starting mark, and you cannot get 15 mark, or worst, you cannot get 10 mark, you are getting 2, you are getting 5. Maybe in other area they are testing one standard, or ratio analysis, you even get everything. So forget, you cannot pass that course. So that is type of the strategy, the exam skills that you need to develop, not only in this course, in every ICAN course. You need to know their strategies, what works and what didn't work. And for all their courses, they have different approach. How you are going to pass this particular course, financial management, if you use the same approach for audit and assurance, you may fail. So for every course, you need to develop strategies for it. So that is that on the content of the financial management. And quickly today, we are going to start with the introduction and the chapter 1 based on their syllabus. So another thing that we also give you as type of assurance is you can well rely on the materials that you have at your disposal for now, even though there is no official material. And still, I'm still going to send some textbooks. So for anyone that have strength to read, to also go through it, because the fact that for the ICAN, they are just introduce financial management, it is not a new thing, because this financial management, it is a course that is being taken at the intermediate level of ACCA, which is equivalent to skills level of ICAN for a long period of time. So the recent developments in ICAN is also type of their strategic efforts to make sure that they meet up with international standard. So when the actual study test come out, you will see that like what you have now, like 90%, there won't be too much differences, because this one is being developed using the financial management prepared by ACCA. So you can see all this strategic business leadership, strategic business reporting are something that ACCA have been developed, have been doing. It's part of their course. And I can just rename in their own to align with that international standard. So this is chapter 1, and all these chapters are aligned based on the new ICAN syllabus. So we are going to be looking at the nature and purpose of financial management. And I say this will be our rudiment, our foundation for everything that we are going to learn in this course, both theory and calculations. And another one, I'm going to focus more on calculation. After this today's session, our next session, we are going on calculation straight. So I expect every one of us, since we have our material at our disposal, to start reading on our own. And when we come to class, if you have any terms that you want us to shed more light on, so you will be welcome. And we'll give you our explanation based on our best understanding of that terms. So financial management. So it is not a complex time or a new time to all of us. So that is why I say, if you just understand, you don't have any problem. So, and this my financial management is deal with planning, organizing, directing, and controlling of financial resources of the organization. And when we are talking of financial resources, so what is financial resources? We mean assets of the organization, fixed assets, plant and machinery, receivable, cash and investments. Those are the assets that organization is using to generate income. And if it is surplus, they invest part of it. Yes, the class is being recorded. Yes. And that even remind me, I'm supposed to say that before I even go on the first chapters. So because for this class, we are going to be making use of Google Classroom. So I'm going to send a form to our group. So that all of you are going to submit your email address. Then I will add you to the Google Classroom. So there I will be posting our assignments. You will be having quizzes to answer to. So everything, the material that you are going to be needed. And also about class being recorded. So the record class will be only be available to those that attended the class. So that is the purpose of also collecting your mails. You are going to have access, you that is attending the class. So maybe you want to revise what we have said in one class. But for those, if you don't attend the class, this class is private. So you will not have access to our recorded class. So that is it. So going back to the financial management. So I have said that just how the company plan and manage its financial resources. Simple as that. Put it in your own words, put it the way you like. The objective is you understand what financial management means. And we have function of financial management or function of financial manager. What are they into? So, and based on many theories in academics, it's widely divided into three. Yes, that we have investing decision, financing decision, and dividend decision. So in some academics, so they go much as 5, some 4, especially the risk management. So they still believe that that is part of the financial management functions. So now I will be trying to, as much as possible, to link theory to the calculations. So let's look at investing decision. The company has to make decision either to embark on one project or to buy a certain investment, maybe to acquire a company or to buy a shares from another company. So those are the investing decision or investment decision. So, and how are they going to make that decision? So when you go back to our part C of the content now, which is the one that is carry higher percentage, 25%. And what that thing is dealing with, it is dealing with investment appraisal, isn't it? So that's why I say chapter 1 or the part 1 is our foundation, that if we understand it very well and we link it, the whole content of the course is going to be a piece of cake for us. So before you can make investment decisions, so you need to do investment appraisals. And that is one of the area, because when you are seeing your question after a lot of narrations, your requirement is going to be advise the company or advise the management whether to embark on this project or not to, or if they have many projects, which one they should embark on based on their resources, because the resources is always scarce. We always have limited resources. So sometimes company may have like 5 projects that they are willing to do, and even those 5 projects might give them a positive return on their investments, but they don't have resources to take up all the 5 projects at a time. So they will say based on their project. That is why the capital rationing will come up. So for you to advise, the question that they are going to ask you is going to be very simple, but for you to advise and your answer to is just a line of sentence, a single sentence, to say yes, based on the analysis, the company should go on this project or shouldn't go or shouldn't invest on this project. But before you can come to that aspect, you need to appraise the project, do many calculations. So the second functions of the financial management, which is financing decision. So when you also check the part D, which is business finance, so what you are going to dealing with there is the calculation, the appraisal, to see the best way to finance your investment. So that is the business finance. And you can see that it only take 20% for you to make that decisions. So, and the third one is dividend decisions. So dividend decision, you may see the calculation there too, because the decision is lie on when the company has surplus, what percentage to share with the shareholders or the investors, and what percentage to reinvest back to the business. Basically, we call it return earning. So business has to make decisions, because all those decisions, they are very critical. They are germane to their success, to their long-term objectives. Because all those decisions, they send signal to the investors and to the outsider, to the potential investors. If you want to invest in any company like banks, GT, Senate, so most of us, we believe that if the one among them that is paying dividend based on their rate of the dividend that they are paying, that may be our a main influence to invest in that particular companies or bank. And in some time, we may dealing with the growth rates. If the sales of GT is in 11 naira at the beginning of this year, and today it has reached to like 22 or 24 nairas, like it has doubled. So we see growth potentials. So it may also be a drive for us to invest in that company. So all those decisions are a decision for the financial management. So it's very important to the company. So now that we have talked about the functions of financial management, okay, the risk management as well. So the risk management, the company has to manage its risk very well. Because let me take you further to a very complex details. So like all the institutional investors, big bank, like America Express, Goldman Sachs, all the international institutional investors, before they can invest in any company, they will do their due diligences, do their own appraisal, a thorough analysis. So, and before they will invest in one company, they will see their capital structures. What I mean by capital structure is what percentage is a debt capital, what percentage is owner equities, and what is the risk, what is the term. Is their bond secured or unsecured? So they want to know their level of risk. And the higher the risk, the higher the returns that those investors will demand from that company before they can invest in that company. So risk management is also important for the companies. So now in a financial management landscape, we have understood what is financial management and what functions financial management or the financial manager is playing in a company. So, and all these things in your organization where you are working, all these things exist because this financial manager or management is something that is very wide. So if you have a company, if you have your CFO, so you see that the accounting department, the business, anything related to the finance, the treasury department, they will under the CFO. And that is the person that's dealing with, that is the financial manager of the company. That is the person that's dealing with these decisions. So now that we have talked about what is financial management and what functions the financial management is playing. So how financial management is being able to play these functions. So we need to look at it. So the next thing that we'll be looking at is going to be financial intermediaries. Financial intermediaries. So because if a company want to invest today in a particular company or in a particular project, or a company want to raise finance to support its particular projects, it doesn't need to go directly to the person that is going to provide that finances. Or you want to invest in a project, it doesn't need to go to the owner of the project. For instance, now you want to invest, or your company want to invest in UBA shares or Dangote shares. You don't need to go to Dangote website or you go to their company, express your interest. You don't even need to meet. So as far as their shares is traded in exchange markets, So you can make your transaction, you can buy your shares, you can raise finance. So those people or those organizations or institutions that made this thing possible are the one that we call financial intermediaries. And I'm going to give us popular one. Commercial banks is one of the financial intermediaries. The reason why is you can raise finance in that bank, and you can also invest. You can save your money in the bank in a saving that will yield you interest, and you can also borrow loan from the bank. So among the financial intermediaries, we have commercial bank, we have investment banks. So the difference between commercial bank and investment bank is commercial banks, their main focus is transactions to facilitate payments. They are also engaged on investment and raising finance, but that is not their main area. Just to facilitate a transaction, you're sending money to your supplier, you are using bank, and they are getting their own charges, maintenance, interest, and getting you short-time loans also. But for the investment bank, their main purpose is investments. That is what they are dealing with. This FDSH, Stanbic, their investment bank, that their main focus is to invest in a project, buy share, invest in a company, and raise large capitals. So another financial intermediary to be fund managers, mutual fund managers. And we also have institutional investors. Institutional investors like unit trust, pension funds, insurance company, they are institutional investors because all the money like pension, like insurance, all these unit trust like real estate, all the money, all your investment with them, that they are raising money. So they are also invest to make sure that it generates more returns. All the pension that we have been contributing, it's not that they are saving it. They are invest. They have different portfolio. They are invest in different company. So that's why we have pension fund management. So those are the financial intermediaries. And another place that we can call what we can also call financial intermediaries, we can also call our brokers, that they are operating in stock exchange markets as an intermediaries. So you can see some brokers and all these institutional investor or fund managers. If you are being using this app, Greenwich, Cowrywise, Piggy Fest, their fund management, they aggregate fund from us and invest in different projects. So these are the financial intermediaries. So let's be linking together. Companies has a function of investing, the investment decision, financing decisions, and these financial intermediaries are helping them by provide a channel and avenue for them to making that decisions. So let's look at the functions of financial intermediaries. Functions of financial intermediaries. What is their functions? So another functions is maturity transformation. Maturity transformation. So I believe the class is being recording, and we also have a Gemini notes. You can get the transcript of the class later after the class. Because I know most of us, we are not with our paper and pen. But you can still read the textbook anyway. So the first function is maturity transformation. So these are the key terms. If they ask you what is the functions of financial intermediary, and you first list maturity transformations, and you explain it in your own words, you get your mark 100%. So what is the maturity transformations? We explain in form of examples. In a commercial bank, customer A want to borrow money. Let's say, for instance, customer A want to borrow 5 million naira. Customer B also want to save 5 million naira on a fixed deposit to the bank. But customer A that want to borrow money, the maturity period that is willing to repay the money is 1 year. But customer B that want to save that money, the maturity period that he want to take is principal money, is capital, and the return back in 6 months. So that means if they borrow customer A that money now, when the customer be ready to get his money back, he will not be able to do that because customer A has not ready to pay back. But when the bank aggregates different savings, maybe customer A now bring the money, he want to get his money back after 2 months. So before that 2 months, another customer will come and also say, I want my money at 2 months. Before that end, another customer will come and say, I want my money after 3 months. So it is continuous like that. So that one give them the opportunity to borrow the person that want to borrow for a year, access to give him that money. So by doing so, they have transformed the maturity by having different investors and different borrowers that they need their money at different time scales. I believe my explanation is understood, isn't it? Yes. So that is the maturity transformation. Another function is aggregation of funds. So in explaining this maturity transformation, I think I have also explained that they aggregate the funds together, different small saving. They aggregate it together to make it a huge amount that they can borrow to the person that need large capital. And another function is pooling losses or risk transformations. Pooling losses or risk transformations. What this simply means is, if there is no financial intermediaries, if I have 1 million to borrow and I borrow it to one company, so that means my risk is very high, because if that company cannot pay my money, so that means I have lost my investments. But when I go through the financial intermediary, I save my money there. So that's my money and the other money that they have aggregated. So they borrow different different companies that they have done their due diligence, that they know that at least 80% of this company will not default. So they have spread my risk for me. And also to them, they are also taking the risk because in time of saving, it's a secure investment that I know that even if they cannot collect that money back from the person or from the company that they have borrowed. So I'm expecting my money back unfailingly, and they are going to pay me back. So I have transformed my risk. So these are the functions. So there are many functions. When you are reading your notes, you are going to see many functions of financial intermediaries. So, and another thing that we are also going to look at this is the financial market itself. So the financial market itself. So what is the financial market? So I believe that all of us know the financial market. You can see, simply put, the financial market is where the short-term and long-term instruments or securities have been traded or exchanged. So that is some terms that we just need to be putting in our definitions. So like that word instruments, because all the things that company is buying, the investments, we regarded them as financial instruments or the securities. And we have two type of financial markets. This one is just type of revision. I'm reminding you, if at all you have forgotten. We have two type of financial markets. One, we have money markets and we have capital markets. So money market is where short-term instruments and security have been exchanged or traded. Simple as that. And capital markets are where long-term securities and instruments have been exchanged or traded. And we said that financial market is where short-term and long-term security and instruments have been traded. Simple as that. So let's look at money markets. So we are going to be, what are the instruments? We are saying instruments have been short-term instruments have been traded in money market. So what are that instruments? So the instrument is categorized into three. That is instrument that is being traded in money market is categorized into three. So this one that I'm giving you now is type of advanced level, because in some books or during our day in universities, they will just listen the type of the instrument that is being traded. Treasury B, this and that, you will list it. But at this stage, you are expecting to be demonstrating like high level of skills. So the first thing is to categorize them before you starting list type of the instruments. And even if the exam comes, they don't ask you to categorize, they are just saying list. So when you are listing and when you are defining your listing, like Treasury B, for instance, Treasury B is a government bond, short-term government bond, is type of so categories. So you demonstrated high skills of what you are explaining. So the three category, the first category is interest-bearing instruments. The second one is discount instruments. And the third one is derivatives. Derivatives. So the first one, interest-bearing instruments. So one of the example of interest-bearing instrument is certificates of deposits. Certificate of deposits is short-term instruments that used to its maturity like maximum of 270 days. So that is like 9 or 6 months. So it is not up to 1 year. So and these certificates of deposit, it's used to be given by commercial banks or big company with highly rated credit levels. Fixed deposits that you deposit in your bank for some time, for maybe like 3 months or 6 months. It's type of interest bearing because you are going to get interest on it. Currently fixed deposits in Nigerian bank, you can get it from 17% up to maximum 24% your fixed deposits. And we have short-term loans. So short-term loans with interest bearing, maybe from banks or from any other institution, is type of what you can get in money markets. And they are categorized as interest bearing instruments. So the second category is discount instruments. Discount instruments. And one of the widely known example of discount instrument is a treasury bill. The treasury bill. Treasury bill used to be matured 3 months and it is being issued by government. And treasury bill, you don't get interest on treasury bill. It's a discounted bill. Because what actually happened for those of us that maybe were working in a treasury department, or we have an idea, if you want to invest in treasury, normally treasury bill rates is 25%. That is the standard. It may be plus or minus, but that is the standard. 25% of your investments. So if you are going to invest in treasury bill, let's say 100 million, for instance now. So when you go to bank that is being authorized to issue or register treasury bill on behalf of the government or through financial market, through the stock exchange, that is money markets parts, that you go there and you go with your 100 million for investment. So at a point, instant, you are going to get your 25 million. What you are going to pay, that 25 million now is 25% of your 100 million. So what you are going to pay is 75 million and the face value is 100 million. So it's a discounted bill. So when it is mature, you are going to get your 100 million back. So treasury bill is a discounted bill. So another example of discounted bill is a bank bill. So the bank bill is a situation where a bank issue a bill on behalf of another company. For instance, if one company is owning another company, let's say 200 million, for instance. So if that company that is owning it has a good credit rating, it can go with its bank and ask the bank to issue bank bill. for that particular companies, so that when the bank issue that bank bill to that particular company now, it is that bill now, it is becoming security or instrument that can be traded, because bank has given that another company the assurance that at the agreed date we are paying you your money. The bank itself has take the liability that we are paying you your money. And anybody that see the bill, the company too that have received the bill may not wait till that agreed date, may sell it at money markets. But it's usually short time period, like 3 months. So that is the bank bill. And we have a lot of instruments, like commercial papers, many things like this bank bill. It is, they call it negotiable instruments, but it fall part of the discounted instruments. And the last category is derivatives. Derivatives. So most of us that we are into maybe cryptocurrency trading or forex, so we should know this. If you know option, you know forwards. So derivatives is type of the financial instruments or securities that it follows derived. That is where the meaning of derivative come out, that the security or the instrument that it follow, it won't follow, is being derived from another value of another instrument. A derivative is an instrument that it is value is being derived from the value of the value another instruments. So the value is plenty, but I hope you get the point. So I'm just saying it directly based on my understanding. And I'm going to give you an example. So when you have a forward agreement maybe a currency forward agreement. If you agree with your bank today that you are going to buy dollar at rate of 1,500 naira at the end of this month, and you have that agreement, you have signed, it is become instrument, and you can trade it in the money market. That is the funny thing. So at some time, you may be at loss and you may be at profit. So for instance, now, if you have that agreement, you make the agreement at the beginning of this month that you are buying a certain amount of dollar, let's say $5,000 at rate of 1,500 naira at the end of this month. So if, for instance, today, the rate of dollar per naira is 1,550 naira, that means the rate has increased by 50 naira. So if you multiply that 50 naira, multiply by that 5,000 that you want to buy, that is like 250,000 naira. That is your gain currently. So, and the funny thing is, this type of agreement, sometimes that is why we have what we call hedging. Some are hedged it against the foreign exchange risk if they are dealing with international payment, but some is just for a speculative purpose. So if you are trading forex, you are trading forward, you are doing forward trading in crypto. So that is speculative purpose, because you don't want to, you don't even need, you are not expecting to pay in dollar, you are not buying anything, you are not hedged against any risk. You are just doing it for the speculative purpose, and you can do that. So when you do that now, you have your this thing today, you have your agreement signed that you are going to buy that dollar 1,500 naira at the end of the month. Today, the rate is 1,550 naira. So that your instrument can be traded before the maturity in the money markets. And the thing is, when you have such type of buffer agreement, it will included whether it is deliver contracts or undeliver contracts. So you that you are doing speculative purpose, your contract is undelivered or netted. Can call it netted or undelivered. So what deliver and undeliver mean is for a company that they are doing it for hedging purpose to hedge against risk. So that means they will actually buy it at that rate at the maturity date. So for you, for that is undelivered, you are doing it just for speculative purpose. So at the maturity rate, you are going to settle yourself based on the nets. If at the maturity rate, the dollar has come to 1,600 naira, now the difference now 100 naira multiplied by 5,000, that is around how much? Like 300,000 or so. So now that's amount now. I say 300,000. I think it will going to be like 300 million. I said that like 3 million. So that one now, your bank is going to pay you just the nets. And for you too, if the dollar has come down, you are paying the bank the differences. So that is derivative. All those derivative is also being traded in the money market aspects. So the second part of the financial market, which is capital market. So that capital market is also further divided into two. We have primary market and secondary market. So the primary market is a market purposely for a new issues of instruments. When the company want to go on public, want to list their shares for the first time. So they will set their prospectors, their brokers. So there are different strategies. Or you want to issue a bond. The company want to raise capital. So the primary market, it is where they are going to do that. So for the new issue, any new issues of long-term security have been done in primary market. So the secondary market is trading markets where the existing securities and instruments, bond, share, like Nigerian Stock Exchange. That one is capital market and it's a secondary market where you can buy shares. So, recently some banks, when the CBN increased the capitalization rates for the bank, that many bank issue shares. So they issue new shares. That one is new issue and it has been handled in the primary market. Although most of the one that we have buy, you may buy it secondary market because I told you there are many strategies in primary market. We have what we call placement. There are some broker or institutor that first they will acquire all those shares primarily, then take it to secondary market for the people like us to have access to buy. So secondary market is where you can trade the existing securities before the maturity day if it is bond. And you can also exchange your shares. So all those places now, the company, let's go back to the foundation of financial management. So the company that want to invest can do that in financial markets, can invest. The company that want to raise finance can do that in financial markets. So before we round up the class, lastly, let's also quickly talk about the corporate objectives. Corporate objective. And this one, exhausting already. We just brush it. So they believe that corporate objective, the main objective of any company is to maximize the wealth of the shareholders. So this maximization of the share of shareholder, there is not an argument about the actual objectives, but where the argument come up is how companies will achieve that. So that leads us to other different stakeholders. Who are the stakeholders? The stakeholders are people or organizations that they have one or two interests in the company or in the activities of the companies. So, and we have internal stakeholder, we have connected, we have external stakeholders. So internal stakeholders, your employee, the management, so they are the internal that is been working with employee. And we have connected. So under connected, that is where we have the shareholders. You have your customers, you have your suppliers. They are the connected stakeholders. And we have external government agencies, trade union. So they are the external. And in some lexical, in some textbooks, they may also say we have primary and secondary. And they believe primary shareholders should be, primary stakeholders should be the shareholders. So each and every one of the stakeholders has their interest in the companies. So, and they believe for the company to perform well, it has to meet the interest, the expectation of each stakeholders. So let's link this to the examination. I'm going to give you tip in this. Question may come in theory, and it may even come in calculation, that one of the areas that you are going to make your decision, you are going to consider certain stakeholders. So your job here, you identify the stakeholders and you identify their interests. And in the identification of their interests, you also need to identify the priority of their interest. The priority of their interest. So sometimes, let me give you an example. The main interest, the owner of the company is the shareholders, and the objective is to maximize their wealth. So now, the government interest too in doing that, you have to consider that, because sometimes question may be tricky. A company want to invest in a project, for instance, that is going to get return of 80%, highly return. And that is what shareholder wants, that we maximize their wealth. And you as a manager, as a financial management or manager, because that is your work, your own work is to serve their interest. Because the relationship you have, principal agent relationship with each other, you have to serve their interest. They are the owner of the companies. And invest in that project is going to be their interest because they are going to earn a lot of returns. But what if those projects, it is something that ethically it is not right or is prohibited by companies? Maybe you want to sponsor or you want to invest in a company that is selling cocaine or that is doing smugglers, because you will get high returns. So at that point, you need to bring in your own professional judgment. But as far as you are concerned, as an ICAN student and potential chartered accountant, our policy, what's the principle that we are follow is not highly strict. It's not a strict rules. The principle is either you follow or you explain. Even if the question, for instance, say that choose the decision, make the decision that we maximize the shareholder weight. You understand? They even ask you directly. And you reading the question, you know this thing is not ethics. You consider the other stakeholders. So when you are explaining, you can say, though this investment is going to bring highly return to the shareholder in their interest, this is the best, but considering the regulatory requirements, this thing is not followed the well rule. Therefore, I cannot advise the company to take up these projects. So you see what question asks you. You see the requirements that you should take the decision. That is the requirement. But now, you, Oga, you are telling them that I'm not doing like that. Amend you, you are getting your mark. That is what they want. That is what they want you to tell them. Because they expect you to brought in your professional judgment. So that is it on that part. And the last thing here, let's also deeply look at this wealth maximization. It is also another tricky thing and another topic of discussion in financial management. How companies can maximize the shareholder wealth. Because many scholars argue that profit alone cannot maximize shareholder wealth. So before, what is even the shareholder wealth that we want to maximize? So the shareholder wealth can be viewed in two ways. In terms of dividend yield on their investment, how much dividend their return on investment, how much dividend they are receiving from their investment. The highest the dividend, the highest maximizing the shareholder wealth is. Or what is the growth rate on their shares? The higher the growth, the higher the company maximize the shareholder wealth. So profit alone is not an indicator that a company is maximizing shareholder wealth. That is another tricky question. I'm telling you this, I want you to understand, to get the knowledge, not just to read at peripherals, to get the deep understanding so that even when you are reading, you are reflecting. So, for instance, now, there are many ways that company will make profits and shareholder weight will decrease. Let me also give you a sample. If a company make 80% of profits, or let's say last year company make 10 million profits, this year company has make 80 million in their profits after tax. And last year, their shares is been selling on stock exchange. Let's say 13 naira. So this one that I want to tell you is not even like an hypothetical examples. It's real life here in Nigeria. Real life company example I want to give you. But I will not tell you the name of the company. Something that we get under a confidential privilege. If you want to know, you can go and research on your own. That last year, the company, their shares is around $13. But this year that they are making 80 million as profit, the sale go down from $13 to around $8 or $7. Decreased by 80% or 90%. So why so? Because the investors, I told you, those big investors, they do a thorough analysis. It is not our own that we are investing based on what our mind proves, based on how we feel. No, they make a thorough analysis of the company before any institutional investors can invest. So what really happened in the company is they realized that the company able to make those profits because the management want to meet up with their performance and most of the things that company has to do, like their equipment, the plant and machinery has worn out. They're supposed to invest in those assets, but they refuse to invest in those assets because the implication of their investment is if they bought a lot of fixed assets, though we know that fixed assets is not something that's going to reflect in profit, but the implication is if you bought a lot of fixed assets, is going to the implication is you are going to have higher depreciation, and higher depreciation will reduce your profits, and they don't want that. And when the investor they do the analysis, they know that all their plants, everything that they have, that's outdated. They don't have it, so they are forecasting that in the next 1 year or two, the company may break down. So everybody is withdrawing his money, despite the fact that they are making profits, because the share growth is being what the driver of the share growth of any company is not actually on their financial statement or the financial report that they submit now. That one is historical reporting. What will drive the investments, the future, their future potentials, that is what the investors use. So sometimes you need to be careful. Company making profit doesn't actually mean that they are doing better. So that's it. I don't want to be talking too much because if I say I will be giving you a sample, I can be giving you many examples. So if you are a fan of football, if you look at Arsenal, Barcelona, like 5 years or 6 years ago, where all this Iniesta, Messi, Safi, that they are there. They are the best club. For all these players, they are the best player. But you see, if you check their value, you will see that maybe they only have like 3 or 13 million pounds value. Because they are old. They're supposed to have been replaced. But they didn't. But you know, when all of them broke down, they go before they can even get that team back up to today. They are struggling. The same thing. Arsenal. The same thing, Man U. All these Alex Ferguson as a winger, they use all their players. they wear them out finally before they release them. So sometimes, as far as investors is concerned, company doing well, making profit is not actually mean that they are doing well. So you have to do your thorough analysis. And that will be the end of our class today. And another thing that we say, we also have a working details. So I have notes, I have working that I have solved, that I've prepared. Everything, all the working that I want to do, self-explanation, you will see question, you will see answer, all the step has been explained step by step. And I believe that it's going to help you a lot for those that have interest. But that one is not free. It came at a premium. So it is kind of textbook, I think getting to like 200 pages. So I have given it out in a token price of 5,000 naira. So if you have interest, if you have our summary notes at the end, you will see the link that can take you to where you can get that summary. And for our class, irrespective if you get the summary or not, so what we are going to be solved is different. So I will be releasing my class notes if we have calculation to give you before the class and so our class will be holding free of charge as promised. But if you have interest, I believe that is going to also add and contribute to your success in this financial management course. You can get a copy. You don't even need anyone to teach you that. You are going to learn a lot from that. So that is the end, and we will communicate in the group. All what I say, like your email address, everything that we require, will be communicating on group to order on that. So this is the end of today's class. And if you have any observation questions, maybe how the class supposed to be taken, on what we have said so far, any expectation, so you have a floor, you can ask your question before we call it a day, please. If you have a question, just kindly raise your hand, then I will allow you to speak. Any question at all? Are you guys with me, or you are just joining and doing other stuff? Anyone here with me? Okay. So I believe there is no any question. So if that is the case, I'm going to leave, but actually I would say I'm not really happy with that because I'm not sure if what I've been saying is actually being taken seriously, since we don't have anything to ask. All right. So if there is no question, then we call it a day. Thank you all. Thank you for your time. I wish all of you success in this course and other course that you are embark on. And as a word of motivation, we also love to tell you that this thing, not even financial management, all the ICAN courses, there is nothing special in it. If you have been taking it before or not, or you are just a newcomer, there is nothing special. Nothing at all special. So it is something that you can do comfortably. And very soon, I know you are going to testify on what I just said. So thank you all. Have a blessed day. Bye.